Welcome to the most critical analysis you'll watch this year. In the last 72 hours, two seismic events have converged to create what may be the greatest crisis in precious metals history. And almost nobody is connecting the dots. On one side, President Trump just announced a 10% tariff on European nations, including the UK, as leverage to acquire Greenland. The mainstream media is laughing, treating it like a joke. But while they laugh, the bullion banks in London and New York are screaming. On the other side, leaked documents are circulating through institutional trading desks suggesting Bank of America and Citigroup are sitting on a combined short position of 4.4 billion ounces of silver. That's 5.5 years of global production. These aren't separate stories. They're two parts of the same catastrophe. And by the end of this video, you'll understand why the global silver market may be hours away from complete collapse. Let's start with the tariff that nobody saw coming. On Sunday, January 18, 2026, President Trump announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, starting February 1st. If no deal for Greenland is reached, that jumps to 25% on June 1st. To most people, this sounds like politics. But to the risk managers at JP Morgan and HSBC, this is a nuclear bomb. Here's why. The global silver market depends on something called fungibility, the ability to move silver bars between London and New York cheaply and easily. The banks play what we call whack-a-mole. When silver prices rise in New York due to high demand, they take metal from their vaults in London, specifically the LBMA, fly it to New York, flood the market, and push the price down. When London runs dry, which is happening right now due to Indian and Chinese demand, they take silver from COMEX vaults in New York and send it back to London. This constant flow across the Atlantic Ocean is the lifeline of the price suppression scheme. It allows banks to pretend there's always enough silver by shuffling it to wherever the fire burns hottest. But what happens when you put a 10% tariff wall in the middle of the Atlantic Ocean? Starting February 1st, if a US bank ships silver to London and then tries to bring it back, they pay a 10% tax on the value. At $90 an ounce, that's $9 per ounce, destroying the profit margin completely. Trump has effectively turned the US border into a one-way valve for silver. Metal can come in, but it can never leave without a penalty that wipes out the bank's equity. This creates what we call a roach motel effect. Silver checks into the US, but it doesn't check out. The LBMA in London is now cut off from its main supplier at the worst possible moment. Based on vault data, London is critically short of physical metal. The flows to India and China have drained LBMA vaults to historic lows. They were counting on the 4.2 million ounces withdrawn from COMEX on Friday to save them. But because of this tariff news, that cavalry isn't coming. Now let's talk about what's really happening behind closed doors. A highly controversial, unverified ledger has gone viral across institutional trading desks. This document purports to show shadow short positions of the largest banks in the world. Positions hidden in over-the-counter derivatives markets that don't appear on official government reports. According to these leaked estimates, Bank of America and Citigroup could be sitting on a combined net short position of up to 4.4 billion ounces of silver. Let me put that in perspective. The entire global mining industry, every mine in Mexico, Peru, China, Russia, and Australia combined, produces approximately 800 million ounces per year. If these banks have sold 4.4 billion ounces, they've sold 5.5 years of total global supply. They've sold silver that hasn't been mined yet. Silver that won't be dug out of the ground until 2031. This is the textbook definition of a naked short. They've sold a promise they cannot physically keep. Now, let's do the math that mainstream media is too afraid to do. Take the current price, $90 per ounce, multiply by 4.4 billion ounces. The result is $396 billion. This isn't a trading loss. This is an extinction-level event. For context, Bank of America's total equity is around $270 billion. Citigroup's is roughly $220 billion. If this short position is real, a single commodity has the power to wipe out both institutions completely. Every time silver goes up by $1, a short position of 4.4 billion ounces loses $4.4 billion. When silver went from $50 to $90, if these rumors are true, they lost approximately $176 billion in paper value. This is why we saw that violent flash crash on Thursday, from $92 to $86 in minutes. They weren't trying to make money, they were trying to stop the bleeding and prevent a margin call that would liquidate the bank. Here's where it gets terrifying. These two events, the tariff trap and the massive short position, are now colliding. The banks are trapped in a mathematical prison. They owe billions of ounces but can't access supply. The COMEX registered inventory is down to 120 million ounces. The US Mint has suspended sales. London's vaults are empty. And now, thanks to the Greenland tariff, they can't even move metal between markets to manage the crisis. The banks now face an impossible choice: keep their metal in New York and let London burn, or send metal to London and trap it there forever, leaving New York exposed. Because most of these banks are US domiciled with massive US operations, they'll likely protect COMEX and circle the wagons around New York. This leaves the LBMA exposed to the full force of Asian demand. The Shanghai vacuum is still sucking, and now the New York spigot has been turned off. We're about to see a bifurcation of the Western silver market. We might see silver trading at $90 in New York and $110 in London, simply because the metal cannot move between the two cities. The law of one price has been repealed by executive order. For the banks holding massive short positions, this is catastrophic. Their hedging models are breaking. Most banks run a global book: long silver in London, short silver in New York. These positions were supposed to cancel each other out. But if London's price screams higher than New York, their hedge breaks and they start losing money on the spread. So how does this end? How do banks escape a $396 billion liability when they don't have the metal to cover it? They don't buy the metal, they don't deliver the metal. They declare force majeure. Force majeure is a legal term that translates to superior force. In contract law, it's the escape hatch, allowing a party to break a contract without penalty if prevented by an event beyond their control. Usually reserved for hurricanes, earthquakes, wars. But we believe the bullion banks will attempt to use it to describe the unprecedented market conditions that they themselves created. They'll claim the Shanghai squeeze, retail hoarding, and supply chain disruptions have made it physically impossible to deliver the silver they owe. And they'll trigger the cash settlement clause. Every futures contract has fine print that says if physical delivery cannot be made, the exchange can settle the contract in cash. This is the nightmare scenario. Imagine you bought a futures contract at $30. The price goes to $90. You stand for delivery. But instead of receiving 5,000 ounces of silver, the bank sends you a check for the dollar difference. Here's your profit. Contract closed. Have a nice day. But you didn't want dollars. You wanted silver. By the time you try to buy physical metal with that check, the street price will be $150 or higher. You've been cash settled out of your position at an artificial price while the real asset moved out of reach. This is already starting. Industrial buyers report dealers quoting unavailable or 6-week delays for volume delivery. When a wholesaler says 6 weeks, they're praying they can find the metal by then. We are witnessing the convergence of a geopolitical accident and a financial time bomb. Trump's Greenland tariff, meant to pressure Denmark, has accidentally exposed the most fragile fraud in global finance. The paper silver market is about to detach permanently from the physical market. The COMEX price will become a museum exhibit, a zombie number on a screen that nobody can actually trade. Meanwhile, the street price, the price you pay to hold metal in your hand, goes vertical. The verdict is clear. If you own physical silver, you hold the asset that banks owe but cannot deliver. The volatility we're seeing, crashes to $86, rips to $92, is designed to shake you out. They want your physical metal because it's the only thing that can save them. The clock is ticking, the vaults are emptying, London is burning, the bridge is cut, and the fire is spreading. Welcome to the age of real money.